Hello and welcome, fellow traders, to a comprehensive guide on mastering the art of effective trading techniques and analysis. In this video, we'll delve into the world of trading strategies, uncovering the do's and don'ts, and unveiling the secrets to making quality trade entries. But before we dive into the specifics, let me emphasize a critical aspect: the proper utilization of indicators. It's a story I've seen countless times. Traders using indicators without truly understanding their essence, leading to pitfalls and missed opportunities. Here's the thing: indicators are your allies, but only when you use them wisely. Pay heed to the telltale signs, like the doji candles in those candlesticks with long wicks. They speak volumes about market sentiment and potential reversals. Without further ado, let's dive into the trading strategy we'll be learning in this video. Of course, I'd like to ask you to subscribe first, hit the like button, and also share your thoughts and suggestions in the comments section. This way, you'll be assisting me in reaching a broader audience. Let's get started right away. Rule 1. The buy label should be observed from the UT Bot Alerts indicator. Rule 2. When we see the buy label, we draw a horizontal resistance line from the peak level of the white-colored bar. Rule 3. We wait for the upward breakout of the resistance line and its confirmation with the volume analysis indicator. We've achieved our initial target of a 1.5 risk-reward ratio. The trader can choose to either fully close the trade or continue with partial profit taking, based on their own preference. However, if the trader decides to continue, it's an absolute rule to adjust the stop-loss level to the entry point of the trade. Please watch the video without skipping, as I'll also be showing you the traps in the market. In this example, we also see a sell label. However, as you saw in the previous example, we don't draw a support line under the bar where the label is formed, because the volume of this bar, confirmed by the volume analysis indicator below, is not approved. We won't take any action on candlesticks that the volume analysis indicator hasn't confirmed. As you can see, the price moved upwards after the sell label. However, we didn't see a buy label. If we had seen a buy label, our entire expectation would have been in vain. A few bars later, we observe a strong bearish candlestick confirmed by the volume analysis indicator. As you can see, the price moved upwards after the sell label. However, we didn't see a buy label. If we had seen a buy label, our entire expectation would have been in vain. A few bars later, we observe a strong bearish candlestick confirmed by the volume analysis indicator. Rule 3. We await the downward breach of the support line we've drawn, confirmed once again by a red candlestick validated by the volume analysis indicator. Currently, we can see this formation on the screen. When applying the rules precisely, we have once again reached our target. I will now show you a high-risk trade within this strategy. Please watch carefully. Although candlestick formations like this theoretically adhere to the rules of the strategy, I do not recommend them. As you can see, a sell label has formed above a red candlestick, but this candlestick is a doji candle. Additionally, the volume analysis indicator confirms the volume of this doji bar. Let's continue with our example. Remember, this is just an example, and even though it adheres to the rules, I am emphasizing the high level of risk. We draw a support line under the confirmed bar. And now, once again, a red candlestick has breached the support line we drew and closed below it. However, this candlestick also appears quite risky. Why? Because despite being marked by an ultra-volume column in the volume analysis, the body of the candlestick is not as large as, or even slightly smaller than, its lower wick. This indicates that the buyers constitute the community forming the lower wick of this candlestick in the market. Even though the sellers are aggressively attempting to push the price downward, the buyers respond to this action by pushing the price slightly higher. As a result of this action, a long lower wick forms beneath the candlestick. Entering the trade under challenging conditions, as you can see on the screen, the trade reached its target, but it took a full 944 bars to do so. I can't label a trade that concludes in this manner as successful, because our goal is to reach our target swiftly in every strategy. Certainly, there will be trades that end in losses, but the shorter the duration of our trades, the more efficient risk management allows us to consistently increase our capital. The strategy in this video generates trade signals frequently, but I advise against entering trades until all entry conditions are met. Until we meet again in another profitable strategy. Goodbye.